It's very hard to have a recession when Uncle Sam's appetite for spending is insatiable, right? As a consumer, it's enormous and it's getting bigger, and it doesn't respond to higher interest rates by borrowing or consuming less.
1, 2, 3, 4.
Hey there. Ever feel like the world is spinning out of control? Welcome to the New Rules with Alan Pentz. Forget the old playbook. It's toast. We're in a new game now, and this is Alan Pentz bringing you 25 years of experience from Capitol Hill to the forefront of business innovation. We're here to show you how to navigate this chaos with precision. Whether it's superpowers jockeying for dominance or inflation shaking things up, we'll help you play 4D chess while everyone else is stuck on checkers. Subscribe now and let's dive in together to master the new rules of the game.
All right, well, great. On the pod today, we have a very special guest, Moses Sternstein. He is the author of an awesome Substack everyone should get and go subscribe to and pay for. As he says, don't exploit him, pay for him. He writes every day. He's amazing. It's called therandomwalk.co. Is that the website?
Yep, that's the
yeah. Excellent. And he's playing hurt today. He got a little tendon injury yesterday, so we appreciate that he made it onto the pod today. But Moses, welcome. It's great to have you here.
Thank you, Alan. Thanks for having me. Looking forward to it.
Yeah, so I've been a reader for probably the last 8 months, 6-8 months, and loved a piece you did that I think kind of hits with a lot of the stuff I'm talking about with the new rules on the transition or the tension between what you call the national nursing home or the finance bros, right? So just kind of give it, outline that tension for us.
So first it's just as a little bit of a, it's not a caveat or disclaimer, but I in my writing, I adopt a persona and I try to, it's a little punchier than I am in person. So when I use things like finance bros or national nursing home, there's a little bit of a pejorative aside to it, but I don't mean anybody any ill wills. But that aside, occasionally I get that. So the piece was like an attempt to sort of think through, which is what I often do, sort of in a longer time horizon, thematically, kind of what the new normal looks like, and in terms of especially how the shape of capital markets has changed, and what the old regime, how would you describe the old regime versus the new regime, and whether these are consistent with each other, whether it's sort of a soft transition or whether they're sort of different models. So the national nursing home versus the finance bros, it basically posits that that there was this sort of, let's call it the finance bro regime, which is sort of the low interest rate regime, really from the GFC recovery until 2022, with the early pandemic blip right in the middle. That was sort of defined by very low interest rates, free capital, with enormous returns to the financialization of everything and the ability to orchestrate, and in a bad way, just there was a lot of money going around. So if you were really good at moving, and accumulating, moving, structuring capital, then there were enormous returns to that efforts. And you see that in private capital markets and private equity and venture capital. It worked quite well for a lot of people for a long period of time. Then of course rates changed and they went up, and they're still up. And even as we had some cuts, the long part of the curve has gone up. That has obviously put a big damper on the finance bro business model. In some ways it's really two things. One is just a price change that happened in the middle of everything, right? In other words, when rates were low, either venture capitalists or private equity, they bought assets at prices that reflected those extremely low interest rates. And now that rates have changed, there's a bid-ask spread that's causing a lot of these assets to sort of pile up and remain unsold, and none of the funds are returning money to their investors, and it's increasingly becoming a source of tension in the private capital markets. But also, more fundamentally, is okay. Let's assume for a moment that there's this sort of one-time hiccup. Is going forward, does the business model, the finance bro business model, the odds continue to work, without perpetually cheap money. In other words, can you borrow at higher rates and still make the sort of fix and flip, or maybe the no fix, just buy, hold, and flip? Does that model still work? And I think there's still an open question there. But on the other end of it is like, okay, in a higher rate environment, a few themes coming together, what I call the national nursing home, which is really a healthcare driven, increasingly healthcare driven economy where obviously the biggest spender in this ecosystem is ultimately Uncle Sam, is the federal government. We have an aging population where, which increasingly represents a larger share of the population. So, the ratio of workers to recipients is changing increasingly in favor of recipients. It's pretty remarkable. We saw some data, I think it was yesterday, just, in the 60s when some of these entitlement programs were passed, mandatory spending, I think, was like 30% of the federal budget. Now mandatory spending is, I think, almost close to 70%. I may be getting the numbers somewhat wrong, but when these entitlement programs were passed, I don't think anybody could have conceived of how dominant a feature they would become in terms of budgetary priorities. I mean, there's a lot of arguing over discretionary spending, but the truth is, there's just not nearly as comparable wiggle room when it comes to discretionary spending as mandatory spending. And that's been a secular tailwind for a while that has been, gradually accelerating, will continue to accelerate as more and more people shift towards retirement. And Uncle Sam becomes a more and more dominant both borrower, right, in terms of soaking up the available capital that's out there. And certainly higher rates make lending to Uncle Sam more attractive, at least in the short term. And that business model has been working just fine. And I think, you'll see, again, this was already happening before, that, either it's, what I call healthcare makes all the jobs, that, healthcare jobs are increasingly a larger share of the jobs that are created. They've always been a large share, but they're becoming a larger and larger share. And, it's, certainly in certain parts of the country. And then that will continue to be a more, increasingly dominant feature while the sort of finance pro model, it's unfair to say that they've been languishing. Well, no, I think they have been languishing, but they've also been remarkably resilient in the sense that, they're still out there raising money, still keeping spirits up, still talking a good talk, and nothing terrible has happened yet.
Having a 10-year hold period helps, right? As Cliff Asness calls it.
Oh, no. I was just saying, at least until somebody, either one of their LPs actually needs some liquidity, if they're a large pension fund or something like that, or, all of the various extended pretend shenanigans, not necessarily shenanigans, that could, again, financial engineering, if any of that blows up, or you have some big credit events, and, but none of that has happened to their, there have been bankruptcies, sure. Yeah.
Well, and to be honest, I kind of take the Cliff Asness theory, who's runs a large alternative hedge fund manager called AQR, and his take is there's almost like a premium in private markets now a discount in private markets now, because volatility washes, right? So you don't, as a LP or somebody who's in charge of these pension funds who invest in a lot of these privates, like private equity or VC, they actually appreciate the fact that they don't have to experience volatility from year to year and explain to their investment committee or their other, their stakeholders why it's going all over the place. They just have, hey, my marks are all good because, Apollo told me they were good, right? So there's almost I'll take a little bit less return so I don't have to deal with the bullshit day to day, right?
But it's the volatility washing. Yeah. It's funny because I'd always heard, Asness's critique or volatility washing, and I also had heard of the the private equity sort of the risk premium that they give themselves, or the volatility premium that they give themselves, and I just thought I didn't understand the concept because at least, and it still may not, because Asness's critique seems such an obvious one, and there's what the industry has said is, if you look at Sharpe ratios, right? The risk adjusted or volatility adjusted returns, private equity is great because there's so little volatility, and there's so little volatility because there's relatively less liquidity. So they're never marking their books. And therefore, based on the return profile and its low volatility, it's actually even better than more liquid things. But that's kind of like saying, if you stick your head in the sand and you don't look around, then it's not there. Yeah, sure. There's something to be said for the ability to be patient and not have to sit there and mark your books like hedge funds do, and certainly you don't have like mark to market triggers like what we had in like the financial crisis, which caused a lot of problem, which was that we had these heavily levered instruments that were, that had mark to market triggers, which, created these forced selling events. But but the idea somehow that like, because it's illiquid, that somehow makes it better rather than just, giving you the ability to look the other way. It sounds kind of ridiculous.
So to go back and kind of summarize this, like, and I just went back, I looked on US Treasury yieldcurve.com, and like, on this day 10 years ago in 2014, these guys probably borrow like the 10-year rate or something like that. I don't actually know, but yeah, 10-year rate was on the 21st was 2.23, and today it's 4.2. So, that's only 2 percentage points different, but in the world of convexity, that's, almost double, right? The cost. So, and what you'll see is valuations were pushed up, right? If I can borrow money cheaper, if I use my discounted cash flow model, like the cash flows are more valuable farther out, right? And or my competition for a safe rate is lower, so I'm willing to pay more.
Right. It pushes more money to the further end. Yeah.
Right, exactly. And so the valuations stay the same, but the cost of capital has gone up. So this isn't computing, right?
That's sort of part one, which is like, let's call it the bid-ask spread shifting and the economics of it shifting. But the other part of it is that the whole point of raising rates to slow the economy is essentially to put out a big money magnet, right? Is to say, you raise rates, you make the risk-free rate more attractive, and it sucks money towards Uncle Sam and sucks it away from other sort of parts of the economy where we see growth. And that's the idea of the overheated economy, which is a term that I hate. It's meant to be rivalrous. And so the question then becomes is Uncle Sam's borrowing needs increasingly grow? Like they are price insensitive, right? Real estate, private equity, hedge, they'll all look at the cost of capital and they'll say, I'm not going to borrow today. Whereas Uncle Sam, like, this doesn't matter, right? They're just borrowing. Like, their demand is insatiable. And so the question is as they soak up a larger share of a fixed pie, or, is there anything left over for anybody else? And then conversely, if the pie isn't fixed, if the Fed gives up and says, you know what, you got to make everybody happy. There are a lot of mouths to feed. So we're going to start, quantitative easing again, and increasing the money supplies, is then, how does that then, come back to inflation, which, again, which is sort of what got us in this most recent episode in the first place, was the relentless expansionary, both fiscal and monetary policy.
Just to go back onto so you had said it was government spending or mandatory spending in the 60s was 30%. Right now it's 60%. And the 70 is 10% of that is, an additional 10% is interest payments. So if you consider that mandatory, right? So really defense is another, whatever, 10%, and then, 15 somewhere in there. And then discretionary is like 10 to 20, so there's just not that much left over after the mandatory and the interest expense. So the narrative being, hey, look, we had the great financial crisis. We brought rates way low. We did all this quantitative easing. Liquidity was all over the system. It spurred these high valuations, particularly in private market. Well, everywhere, really, public markets too, but also spurred, private equity and got them on steroids and venture capital. Then they raised the interest rate during the pandemic because it's, after 10, 15 years of doing this, it finally sparked inflation. Also the supply shocks, right? But now with the rates higher, hey, all this private activity is just kind of ground to a halt, but the government continues to spend. So like you think that 60%, it went from 30 to 60. Well, with the aging of the baby boomers, I'm sure it's climbing up as a percentage, right? So I guess it's a story like there's just this underlying federal spending that's always going to be there. And then they can dial the interest rates up and down to get like the private sector to create inflation or get rid of inflation.
At least for the foreseeable future, it's hard to see, what the alternative is. And it's also partly why, for all, and I can be a doomer every now and again, although I'm probably a little bit more heterodox than that, but it's very hard to have a recession when Uncle Sam's appetite for spending is insatiable, right? As a consumer, it's enormous and it's getting bigger, and it doesn't respond to higher interest rates by borrowing or consuming less. It just keeps on spending, and secularly will continue to spend more until either something breaks or a remarkable achievement of political consensus. I don't know how that will happen. And so, yeah, right. And that's the issue. Is it's just like it's inflationary by itself, particularly in the areas where it operates, like healthcare. And so on the private side, it's just and high rates help it, because high rates help bring the marginal buyer of treasuries to the treasury, right? At lower rates, a marginal buyer of treasury, which is say hedge funds, households, things like that, not sovereigns, they might say, I'm going to help the finance pros out. I'm going to put my money in private equity. I'm going to put my money in the stock market. I'm going to put my money somewhere else, because I'm not getting enough yield from treasuries. But if Uncle Sam isn't getting the money that it needs, it doesn't stop borrowing. It'll just pay higher prices until it does. And that's also been kind of an interesting thing to watch, is who is that marginal buyer of treasuries, right? Because for a while, we kind of acted like the demand for treasuries was, basically who's lending to Uncle Sam is basically, is price inelastic, right? As sovereigns, it's a fairly liquid, cash alternative where people, whether it's China, Bank of Japan, things like that, they don't really care what the yield is. But there's some evidence, but it's not great evidence. It's mixed, that we've kind of all the available price and inelastic demand, the sort of sovereign demand has been tapped, and China certainly has been delevering for a while and going to alternatives like gold and things like that. And at this point, the marginal buyer of treasuries has been hedge funds and household people chasing yield. And if that yield were to go away, like the finance bros hope and expect, right, because they're sort of depending on rates to come back down so that they can get back to business, then what does Uncle Sam do, right? If it can't attract the marginal buyer, where's it going to get the money from? Because it still needs it. So either one possibility is the Fed goes back into quantitative easing mode and starts lending itself, in which case, is that going to be inflationary? Probably, if it starts expanding its balance sheet. Or market prices, just to clear the auctions, drive 10-year yields right back up again. In which case, despite the Fed setting a benchmark rate lower, the risk-free rate still goes higher anyway. So it does seem to be a little bit of a rock and a hard place.
Or they force banks and pension funds to buy the treasuries, right? The financial repression, which they've done before, right? They did after World War II. And I think they're probably going to do. But I do want to put in a couple of caveats. Okay, so first is overall government spending in the economy at this point, like huge, spike in 21, 22, 23. But we're now back at 23% of GDP, which is basically the same as it was in 1982, which again, elevated level, not compared to Europe, but for the United States, we've been at, I don't know, around 20, say. So we're like a little bit elevated there, and that needs to drift down. And I don't see another IRA or bill, like these, or dumping money out right now. So it strikes me that, we've got a little bit too high spending, but not crazy. And taxes are way low, right? So we're at 16% of GDP, where we've normally been at, say, 18, 17 and a half, 18. If those numbers kind of come back into line over time, like, is that as big an issue going forward?
I mean, I would have to look closer at I'm just looking at it now, federal government's budget as a share of GDP. I'm not a huge fan of, I think GDP is hard, right? Because GDP includes, and this is sort of an Arnold Kling point, which I think he's very right. And I've alluded to this often, is GDP, healthcare spending is included in GDP, right? So and again, I think taking care of the sick and the elderly is incredibly important things to do, but that's not a growthy thing. I mean, there may be some growthy offshoots, like you develop better technologies, or people get productive later in life. Sure, fine, great, but that's not predominantly what this is. This is just taking care of the elderly in increasingly expensive ways, and that's not a growth industry. So I'm a little hesitant around there. But the other big issue, and again, without having to dig into these a little bit more, is just where are the tailwinds and the headwinds coming from? And I think as a the 1980s were fundamentally different in terms of the boomers were coming of age and hitting their powerhouse years. They're hitting their 30s to 60s when they're sort of max earners. And this is one of the biggest max earning generations the country's ever had, world's ever had. And we're not there. We're rolling over, right? Population growth is beginning to roll over and flatline. And it's an 100-year, secular tailwind, that appears to be rolling over everywhere. And everybody's sort of looking around confused as why these things are happening. It's just like, in some ways it's pretty simple. Like if you think of any enterprise and you say, okay, is my customer base growing or my market's growing or shrinking? And that's what's happening is this customer base is not growing. It's like the old, I don't know if you know the David Foster Wallace joke from, I forgot his Kenyan speech, but the two young fish are talking to each other, and the older fish swims by and says, how's the water? And or the water's lovely today. And the two young fish look at each other and say, what the hell is water? You swim in something for so long, you take it for granted. And I do. So, even this is not a period where, it's like we're on a wartime footing, but we're not at war, right? That's part of the issue is like would be unemployment is extremely low, and we don't have big tailwinds behind us. We don't have a big booming population out ahead of us. So we should be in a belt tightening mode, not a spendthrift mode, which is, we're acting like we're on a wartime footing when we're not.
I'd have two critiques. One, I agree. Like the other factor there is like that 60% that's mandatory, that a ton of that is healthcare related, right? And income for older people, that's just going to grow as a percentage. So, and take a glance around the world. I don't think we're cutting defense spending anytime soon. So, you're going to get a squeeze on discretionary spending, or like potentially the only really productive spending that the U.S. government does on research and development. You can say all the waste and other stuff, but it is potentially the only productive spending we do, and so that's going to get squeezed, right? And I don't see the tolerance for increased percentages of GDP going to government spending being there, right? So I think that's a concern, definitely. But on the other side, I just had this thought as you were talking, because I've read, multiple people saying, hey, we're at 7% of GDP spending in the budget each year. And we're, that's a huge deficit. At the deficit is like 6 to 7 or something like that. And we're in peacetime. And I think two things. One is, okay, I can look back to the 80s when we were, we're in the Cold War, but it's peacetime and we're spending even more in interest. But we're paying a lot of interest right now because the Fed raised rates to get rid of inflation. So maybe that comes down and all of a sudden the problem isn't as bad. Also, go back to the tax point. But I do think, isn't it also possible that we sort of are at war? Like we already are at war with China in an economic sense. And like you see this in the election and everything. And to be honest, I think some of these distortions are based on China's crazy export-driven industrial policy. And in some sense, we're like already in an economic war with them, and that's driving holes in our own deficit. It's a complicated argument, but it is something that strikes me.
I mean, I think when we think of being at war, or like say in the beginning of the pandemic, is like to say, okay, we've got these expedient circumstances that require us to, put a lot on the credit card now, and we either have no choice, or because of other reasons, we think we'll be able to pay it down later, like the 1940s or whatever, or even the beginning of the pandemic. And in that sense, it's hard. We may be, at economic war with China. It's not like an expediency that demands a lot of spending. And even if it was, that's not the spending that we're doing, right? It's not like, oh, we're with China, therefore we must, expand the healthcare industrial complex. Those don't go together.
Of course, that immediately follows, right? Yeah. That's how you beat the Chinese, is by having more home healthcare aids, right?
I joke, and I have cleared this joke with some of the people, so I'm allowed to say it, is that South Korea is going to or Taiwan is, they're going to welcome unification just to have somebody to take care of them when they're older. It's a big issue. So on the other piece of it, in terms of like, this is maybe a bit of a not a segue, but a little bit of a misdirection here. But like on the China, so I take issue sometimes with China, the views people of China's export policy. I'm curious what you mean by about what in what sense it's crazy, because like I find it odd that people at the same time they'll in the same breath they will talk about all the different ways in which we subsidize our EV industry or our clean manufacturing. We try to create all kinds of ways to make this stuff cheaper, and then in the same paragraph, and they'll be like, well, and these policies are harmed by China's egregious oversupply of EVs, and like they're doing the same thing. Like, they're subsidizing an industry to make it cheaper. They're just selling it not just to themselves, but to us. It's like
it would be the scale across multiple industries. So I think I was reading the other day, I don't have the site in front of me, but their industrial subsidies are at like 5 to 10 times any other country in the world, and they have the second largest economy, right? And
but why do we get to say that ours are just right? In other words, we're basically saying like, subsidize it, but not too much. The idea that we have, we know exactly what too much is, what just right is, and their subsidies have gone too far. It's like, well, what if they say, no, we really believe in clean energy, or this is a real Green New Deal, yours is a fake Green New Deal. It just seems odd to me. It's like, yes, they've taken a different approach to this. They're subsidizing domestic manufacturing and exporting that to the outside world rather than subsidizing domestic consumption the way we do. It's a different approach. But I think the idea that their subsidies are sort of categorically different than ours, we're annoyed that we wanted to make solar cheaper, but not so cheap that it puts our solar people out of business. Like that seems an odd objection to make.
So I would make a Keynesian argument back that beggar thy neighbor policies are making no claim that the U.S. doesn't have their own, right? We have some, we just have a lot less than everybody else, right? And particularly, this also involves capital controls, right? So China is still a currency manipulator, as is Germany and everyone else. And the U.S. and the Anglophone countries are the only ones with no capital controls, right? So that's part of the story. But what I would say is like, hey, if you just keep subsidizing exports you're exporting your low demand to everyone else, eventually you just immiserate the rest of the world. Because the whole point of the system is that you export to pay for imports. Right? That's the whole point of Ricardo's system. And if you just export to export, then you're killing demand in the other country and you're exporting your low demand to the other country. They get low demand, and now everybody's poorer in the end, right? And we're not creating a self-reinforcing economy.
But why is everybody poorer if everybody else gets cheaper EVs?
Because you just keep putting more and more people out of work, right? The export subsidy is not demand-based, right? So like at some point, you just can't make any more EVs that people will buy, right? And if China just keeps doing it, then you're just destroying demand, right? And you're overproducing, which is exactly what they're doing.
I'm not persuaded by it. I mean, BYD doesn't have 100% of market share. Like they're gaining market share, but they don't have all of it. I just like, to me, it's like, they are Chinese taxpayers are subsidizing cheaper goods for the rest of the world. That may be bad or good, but like I don't see that as being somehow categorically offensive. It just seems like, and again, I see it as a different. Whereas we subsidize our own consumption with cheap credit, right? And we put it on the future generations bill and say, here, go spend it. They do it slightly differently, which is to say, well, we're going to subsidize your work, your labor. We want you to be working. We don't necessarily want you to spend. We want you to be at gainful work, but we know that those prospects are not quite as good unless we partly subsidize what you're selling to the rest of the world. But that's what's going to keep you at your job. I don't see those as categorically different, and I think the rest of the world might complain, and that the U.S. through all, some of it is it's playing a bit of a tallest midget game, right? Like we do. Certainly, the way that we subsidize real estate has attracted a lot of foreign capital to the U.S. to park itself. The Chinese would say, you do the same thing with respect to your real estate industry. You guarantee it with super low credit, and it sucks money from abroad to the U.S. and the U.S. Relatively as a share of risk assets is increased its share, right? So it's been a giant money magnet, which is also kind of interesting because it's.
I think you're making my case for me, right? Which is that the only way that system works is if China continues, and Germany to some extent, although they do this within the Eurozone too, recycles their dollars that get sterilized in their country, right, back into U.S. assets. So it pushes up financial assets and things like real estate. And that makes the dollar uncompetitive. I mean, the fact that China's economy has grown, I don't know how many times since they put the peg on the yuan to dollar at 7 or whatever it is, that currency has not adjusted, right? So it's still around 7. I mean, that is crazy when you're sending trillions of dollars over to buy yuan. That's because they're recycling all the assets back in. And I understand that people say it's a choice on the United States' part, but the reality is if you leave your capital market open, you have no choice but to sell the assets, right? And so the assets go up, the dollar goes up, and your exports become uncompetitive. So China's running the industrial policy, not the United States. We have an industrial policy. It's just run in Beijing. And I think that's inappropriate for the country. So I would favor capital controls.
I think it takes two to tango.
Sure. And hey, Jamie Dimon's every bit a part of it as Xi Jinping. I agree. But, I would definitely, we're definitely way deep on this, and we could do a whole other thing on this. I love it. And I'm a big Michael Pettis. And
I'm not a China expert either. Yeah, the thing where I really get, it's just where people talk about, that their subsidies they're subsidizing too much. They're making it too cheap, whereas we made it just right. I'm like, that seems to me is kind of ridiculous.
To be honest, I don't take that other position. I don't think we did it just right at all. I actually think, Michael Pettis and Matt Klein, wrote this book called Trade Wars or Class Wars. And their basic theory was it was elites in the financial and national security elites in the United States and, party and business elites in China are basically in a conspiracy against their own workers in each country. So he's like it's not really a trade war, it's a class war in between these groups. So anyway, we went deep on that. We can have a whole other pod on that, but I appreciate that. But getting back to the basic story is now we're in this higher rate environment, right? So we're talking about PE, VC, they're kind of like extending and pretending. You see it a lot in real estate as well. Valuations haven't come down in private markets. They're back up in public markets, right? And rates are still high, although everyone's betting on them coming down. So that's sort of where we are. But it does look like in the last few weeks, it maybe looks like the rate of decline of interest rates might not be what everybody thinks it's going to be, right? So bring us up then with the Apollo story, because I thought that, like when I read that, I was like, this sounds like ZERP era policy, right? Or strategy. So how do you square that with what Apollo's doing, our situation?
I don't think it's completely ZERP era. Actually, in some ways, I think that for context, so Apollo, is a huge asset manager. It's a publicly traded, originally what we called a private equity shop. And this evolution has been going on for a few years now, but I think the sort of ambition of Apollo's plan is becoming clearer and clearer, and they laid it out in an investor day, a couple of weeks ago. And what Apollo was become quite explicit about is just like they see the future of capital markets as moving from public to privates, and that there's the current enormous component of that has been what's called private credit, which is really just lending, it's banking. But the big distinction is that it doesn't involve banks. If historically credit creation has been the responsibility of banks, using deposits and then the syndicated loan markets, for credit creation, there's this move which is driven by a few different factors. Some of it regulatory, some of it is opportunistic, to move banking away from banks and towards private credit. And one of the biggest impetuses for that is just that it solves the so-called duration mismatch problem, whereas unlike banks, which are funded by deposits, where the great insight of Apollos of the world, and Warren Buffett to some extent, has been, to find a different source of funding, which is annuities, retirement products, right? Because a retirement product deposit is a demand, you can draw it out at any time, whereas an annuity says, okay, I'm going to give you a chunk of money or a stream of premium, which is very predictable, and I expect, a very predictable return. I'm simplifying at the back end. So for an asset manager to say, okay, I've got money now, I have very clear yield expectations over the next coming years. Nobody's going to suddenly you can't make a run on a retirement product. Nobody's going to demand liquidity. So I can very clearly say, like, okay, I know that I need to generate 6% on this, which means if I can generate 8%, then that excess spread is mine, and I can plan for this, and I'm not subject to any liquidity runs. And that part makes a ton of sense. And they've been very aggressive about seeking out retirement money, essentially, to fund their operations, and they've been getting bigger and bigger and bigger. And they, anticipate being an ever increasingly large share of capital markets activity going forward. Whereas, and I can sort of dig into it more, like they see public market, hedge fund active management as being kind of a dead end. And they're not the only ones in that regard. They also see, like, even investment grade credit as being something that is a new land for them to conquer. Where I guess, like, I don't see it necessarily as ZERP. There's going back to there was a Howard Marks essay that that I wrote about, somewhat cheekily, but I think it was a pretty good essay, when that he wrote when the rates changed originally. He's referred to it as a sea change.
Definitely talking his book, right?
And it's also like a lot of words to say what we talked about, which is just like, when rates change, the risk curve moves, right? So, like, it puts a premium when rates are super cheap and money's everywhere. Then, like, having money is not, it's easy to get it, right? So, but, like, as rates move up, then all of a sudden, if you've got capital, you're in the catbird seat, and that shifts the balance from equity to credit. It means you can charge for, you can take lending, like lender-like protections, and get some equity-like upside, which you wouldn't otherwise do when money was all sloshing around. So I think part of the move there isn't Zerpian so much as, like, the private credit model maybe doesn't work as well when rates are lower, just because money's everywhere. But when the advantage shifts towards lenders, then being a sophisticated lender who can also move quickly is a competitive advantage, right? It's like, there's all these, everybody's being a little bit more cautious. Investors are demanding more yield because, like, they're tired of having their money tied up in private capital vehicles that sit there forever. But if you're going to do it, and you can, capital's tight, so you can actually charge for it. But if you're going to do it, you got to be good. You have to be able to underwrite all these different asset classes. And if you're going to do it at scale, you can't just be doing credit cards or just be doing autos. You've got to be able to do it all over the place and do it quickly. And that's where Apollo says, okay, we're going to step into this void that, that's left behind banks, and not, we're going to be a sophisticated player that can operate in this higher for longer environment where some of the advantage shifts from credit, from equity to credit, and we're going to do that too.
Basically, what you're saying is, like, hey, equity was where you got returns when the discount rate, the interest rate, was low. You couldn't get a great return on lending, so you're going to take the cash flows farther out from a huge growth story, right? Like, I want a VC company that's going to be $100 billion instead of getting 10% from you a year by loaning to you, right? So I take equity instead of debt. Now that's kind of flipped.
10%, 5%.
Yeah, 5. Yeah, it was back then. It was right. So now it's like, hey, I can get 10 to 14% depending, so that's a lot more valuable to me today. And, like, I'm not so sure about
and it's backed by assets, so it's on a risk adjusted basis. You're getting better returns, or at least that's the story. Yeah.
And then you go on to talk about, or talking about one of their presentations about this. They talk about this reindustrialization trend, right? So, are they going to harness all these assets to lend? I assume lend and or maybe some equity investment to build out all the AI infrastructure, the clean energy transition. So here's where I get into what struck me is, like, oh, the government might not do a whole bunch more IRA bills, but they might get into this game of creating the incentive system to direct Apollo's capital to what they want. That's what I see happening going forward.
I mean, and to be fair, like, we talked about this before. It's like, the U.S. hasn't imposed capital controls, but it definitely incentivizes the flow of capital, and it does that with real estate for sure, in all kinds of ways, for better. And maybe that's a good thing, because it created this decentralized source of wealth for a lot of people. But, without the 30-year mortgage, that's snapped up by the agencies, et cetera, like, there's no way real estate is valued the way that it is. But yeah, the IRA, in terms of, creating huge subsidies, or increasing subsidies that are already on the books for both clean stuff, but also what we call strategically important semiconductors and probably increasingly alternatives, sources of energy is definitely going to be to affect the flow of capital. And yeah, from Apollo's perspective, and again, it's all all these tailwinds coming together, which is, A, there's, mismatch between the old banking models. B, there is the sea change in favor of credit. And C, it's like, what better time to be a lender at just this moment when there's going to be this whole crop of assets and capital consumptive businesses that are arising just when we're in the position to want to be lending at higher rates.
And I see this whole nexus, right? You had a link here to private credit and insurance are two peas in a pod, right? Because they both have long-term time horizons. So you're matching the assets and liabilities. And then I think, and government and large asset allocators like Apollo are two peas in a pod, because now government has a place. It can, I mean, not that it hasn't had this, but I just see increasingly the government is going to be in the business of dictating where capital gets allocated, and they're going to use allocators like Apollo as part of that, right? Not in the sense that they direct them, but they're going to incentivize them. They're going to regulate them. They're going to do all these different things to get the outcome that they want.
I don't think it requires any secret conspiracy. It's just like they're already doing that just by virtue of being one of the biggest spenders on the block and will increasingly be so, right? I mean, so that's already just the sheer magnitude of the fiscal stimulus that the government provides in the form of healthcare spending. But yeah, then given all of the other constraints and the sensitivity in the capital markets for its own borrowing needs and versus the sort of inflationary mandate, the idea that it will increasingly become more involved in where capital goes and doesn't go.
And I think you pointed out one other thing that I thought was like really groundbreaking to me, which was you're kind of seeing this shift over time, right? How the mechanisms for allocating capital. So like you kind of cite, hey, the first industrial revolution was funded a lot by insurance companies. I mean, there were banks and other things, right? Private, right? We didn't have huge capital markets that were public. Then we moved into the globalization era. That was more capital markets. And now we're moving back. You have a question mark, right? So you're kind of seeing this move to private as also is that a response to the investment challenges going forward? Or is it just a response to explain that transition as you see it?
I mean, again, and this is Apollo's insight, which I just found interesting and kind of underconsidered from the zeitgeist of the mainstream media. But their argument, I think, is just there is a combination of both a new class of borrower, which is these asset heavy businesses in different asset classes, as well as a different environment for lenders. So banks relative to banks which are funded by deposits versus the private credit model, which uses insurance money. And then the third part of it is the LP, a different demand for yield also, which is this retirement community, right? Is that they have money to put away. It is an increasingly large share of people with a large share of money, and they have sort of fixed income demand expectations. It's not high growth demand expectations. So you put all those three things together. It's okay, we've got a source of capital that has certain expectations for yield and liquidity, and that's different than before because these are bigger. It's a bigger share of the overall capital markets than ever been. And in the middle, in terms of who the intermediaries are, banks are that's the old model. They have a high degree of sophistication in terms of what they can underwrite, but in terms of the kinds of products that they can produce, and it has to be fairly within certain boxes that are public market approved by regulators, and the kind of demand that doesn't necessarily work either for the borrowers themselves or for their for the retiree LPs behind them who need a kind of more of a variety. So that's also where private credit steps in. On the other side of it is the borrowers are these different asset classes, semiconductor, whatever it is, and while big banks might have, they have huge capital needs. They need it to be a relative degree of scale and flexibility. Private markets, have flexibility in terms of their mandate because they work with LPs. They're not regulated doing private things, but they don't have the sophistication or the scale to meet, the evolving needs of these businesses. banks have the sophistication and scale, but they don't have enough flexibility on the product and risk side. So that's where private credit sits in, which is like we have, institutional banking level scale and expertise, but we also have the flexibility and nimbleness and speed of what, what used to be, private market stuff. And I mean, again, like, it's Mark Rowan and, is a brilliant guy. And after Jamie Dimon, probably, the second most important person in finance in the world. But like, they're clearly talking their own book, and I'm sure KKR would say the same thing and some of the other big shows. But that's the idea.
But I do like that, like, hey, the kind of thing we need to fund has become asset capital heavy, right? So even think about AI, people are like, is this even really a software model? Because the cost of inference is a huge variable cost, right? So it's not this like, hey, we train it and then it's basically zero marginal cost, right? At least now. And then when you talk about energy transition and digital, blah, 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 it is very asset heavy. So asset heavy lends itself more to lending, right? Because I've got something I can secure it against, and the capital needs are so high. It's not going to be as good a business model. The returns aren't going to be the same either, right?
And it demands kind of scale, and patience and risk appetite, right? I mean, and that's the other part of it too. Is just like, okay, maybe in the early aughts, you could. The borrower's needs were just simpler, right? They just needed a slug of money, and then they would build some software, and then eventually, or what they needed was they just needed bigger and more, and the specifics didn't matter as much. So like the syndicated loan markets and the public equity markets did just fine, but as that sophistication changes,
the future of SpaceX in the past was Uber, right, or Facebook or something, right?
Well, Uber might be part of the future too. Yeah. Well, right. Or like Salesforce or something like that, so, which is again, a great company, but just a very different kind of company than NVIDIA or anything like that.
Yeah. And I think the other implication here, and I think Odd Lots did something on this, is, a lot less visibility into what's happening in the economy. These things aren't going to get marked on asset markets every day, right? On trading platforms. So we're going to have a lot less visibility into it.
That's the concern. But, there are other ways that we can see, like we can see bankruptcy filings, although of course a lot has moved out of bankruptcy to these, to other kind of private restructurings and alternatives to that. But like we can see consumer spending, with fairly low latency by looking at credit card panels. We can certainly see, changes in payroll. So like we might not be able to see quite this with the same degree of visibility, the specific performance of these portfolio companies. But we can kind of symptomatically see, at least as a lagging indicator, not only lagging, like how everything else is doing.
And you can see secondaries, right? And for, at least for PE, basically.
But you can also you can see the dollars moving around. So like, whether or not these, you can look at, if you look at, consumer spending and just see that it's trending, upwards, it's got to be going somewhere, right? So like, presumably, and the same thing, you can look at, SMBs and how they spend, not quite as clearly as individual consumers, but like, until you see nobody's going to lose a ton of money, right? Unless there's some kind of big drop off in how people are spending, I would think, and that would cause people to lose their jobs, which would then cause that drop off to be more severe. The bigger issue is just like credit markets, is just how much leverage is there and how sensitive is the whole thing to small drops in valuation, right? If you have a leverage on leverage on leverage, your equity cushion can be quite slim, and that there can be cascading effects there. Like,
yeah, I tend to think I have sort of like the Matt Levine view that like this will be a trend. And then they're just going to reinvent public markets again, So like first it'll be secondaries, and secondaries will be offered like this, and secondaries will be daily, then they'll be hourly, then it'll be like, oh, well, we need, they just keep they just keep cycling through these things where it's like, hey, we got to be private. Oh, now we need all these things that give us liquidity, and they'll go back and forth. So, and we'll just track it.
And then the regulators will say, actually, all these reporting requirements, they're applying to private companies too over a certain size. And then you end up, and then you'll repeat the cycle too, where the cost of being public will be the juice ain't worth the squeeze, and people will find other ways to kind of exit out the back door, and it'll repeat itself.
This has all happened before, and it will all happen again, to quote Battlestar Galactica. Well, Moses, this has been awesome. I'm glad we could get into it a little bit on a couple of topics and still come out all good. And I'm a huge fan, and I think everyone should be reading the randomwalk.co every day. I mean, this guy writes every day, has like something to say. So like that is super impressive. I do not have that kind of mental throughput in my old age. So, but it's been a pleasure, and we thank you for being on the podcast. Anywhere else you would recommend people reach out?
I'm on Twitter. I do a lot of short form stuff there. That's my name at Moses Sternstein, or Random Walk is the handle. I don't know. This was super fun. I really appreciate it. I could talk about this stuff all day. I could be more acrimonious if you want.
Well, I want to do one of those like intelligence squared debates where like I get Michael Pettis and you get like whoever, you could take Kling or Cohen or, somebody. You can find some, you can get Larry Summers. Okay. Well,
we'll put a little Polymarket line on it and see who wins.
Awesome. All right. Thanks, Moses.
All right. Thank you, Alan. Talk to you later.
You've been listening to The New Rules with Alan Pentz. For more insights on mastering the new game, follow at Pentz, that's APENTZ, on X, and make sure to subscribe to the podcast so you don't miss a single episode. Thanks for tuning in, and remember, in today's world, you don't follow the rules, you write them.